5 assets that vanish when you need them most. What if everything you thought was protecting you financially was actually a trap? What if the assets you spent years building, the ones you were counting on in an emergency, simply disappeared the moment you needed them? This is not a hypothetical story. This has happened to millions of real people across every country at every income level. And right now, it could be happening to you. Stay with us, because what you are about to hear will completely change how you think about money and financial safety. If you find this valuable, please subscribe, because we cover financial truths that most people never hear until it is already too late. Most people assume that owning assets means owning protection. They believe that as long as they have property, investments, or savings, they are safe. But the brutal truth is this: not all assets are equal in a crisis. Some assets look powerful on paper, but become completely worthless at the exact moment you need them most. History has proven this in 1929, in 2000, in 2008, and again in 2022. The question is whether you will be one of the people caught off guard, or one of the few who saw it coming. The first asset that vanishes: real estate. Real estate feels like the safest investment in the world. You can see it, touch it, and live in it. It feels permanent, solid, and real. Tate industry does not want you to know when you truly need money fast, when a job disappears or a medical bill arrives. Your house can be absolutely useless. Real estate is what financial professionals call an illiquid asset, meaning you cannot quickly turn it into cash. Selling a home takes weeks, sometimes months, and in a crisis, it can take even longer. During the 2008 financial crisis, between 2007 and 2010, there were nearly 4 million foreclosures in the United States. Millions of homeowners desperately needed to sell, but nobody was buying. Many homeowners could not refinance or sell their homes due to falling prices, leaving default as their only option. Liquidity combined with high leverage forced many into fire sales, which pushed prices down even further. About $3.4 trillion in real estate wealth was wiped out during that crisis, and around 7.5 million Americans lost their jobs. Real estate also comes with costs that drain you during the worst times. Property taxes, maintenance, and insurance premiums do not pause because your income did. The lesson is uncomfortable, but necessary. Real estate is a long-term wealth builder, but it is a terrible emergency fund. If your plan is to sell the house when things go wrong, you may find there are no buyers, or the price has collapsed, or the process takes far too long. When you need cash most, your property may be completely frozen. The second asset that vanishes: cryptocurrency. Cryptocurrency was supposed to be the future of money, decentralized, borderless, and immune to corruption. Millions of ordinary people poured their savings into digital coins. And then came the horror. In May 2022, a cryptocurrency called TerraUSD was marketed as a stablecoin, safe, reliable, and pegged to $1. The total value destruction exceeded $40 billion. Retail investors who had invested life savings based on assurances the system was mathematically sound lost everything. Luna's price peaked above $116 in April 2022. By May 9th, it had fallen below $30. By May 11th, it was under $1. By May 13th, it was trading for fractions of a cent, essentially worthless. In just 4 days, a $40 billion asset became virtually nothing. The stories from real investors are heartbreaking. "I lost all my life savings," one member of the Terra Luna subreddit wrote. Another posted, "I lost over $450,000. I cannot pay the bank." Moderators of the Reddit page pinned national suicide hotlines at the top of the thread. Some victims lost homes to foreclosure after borrowing against Terra holdings that then crashed, and the collapse did not stop there. Celsius Network froze withdrawals and later filed for bankruptcy. Three Arrows Capital, a major crypto hedge fund, also collapsed. In May, In June 2022 alone, over $450 billion in asset value was destroyed. Here is the hidden terror of cryptocurrency. Not only can its value vanish in hours, but leading crypto exchange, Binance, temporarily suspended withdrawals on the Terra network at one point, meaning even those who wanted to sell were unable to. Asset disappears and the exeter locks at the same time. Cryptocurrencies are unregulated, uninsured, and difficult to convert into actual cash. If your financial safety plan relies on cryptocurrency, you may discover too late that it was never really there at all. The third asset that vanishes, your 401k or retirement account. For decades, financial advisors have told workers to save diligently in retirement accounts. Contribute every month. Let compound interest work its magic. You will be fine. As for long-term investing, this advice is largely sound. But here is the devastating problem. What happens when a crisis strikes just before retirement? During the Great Recession, the S&P 500 fell approximately 56.8% from peak to trough between October 2007 and March 2009. According to Fidelity, the average 401k balance dropped by more than 30% in 2008 alone, affecting millions of investors. A person who spent 30 years building a $500,000 retirement account woke up to find it worth $350,000 or less. Those with more than $200,000 in account balances had an average loss of more than 25%. The people most devastated were those closest to needing the money. If you are in your 60s and your retirement savings crash by 30%, you do not have time to recover. But it gets even worse. Withdrawals from a 401k before age 59 and a half are charged an additional 10% penalty on top of income tax. So not only has the market reduced your balance, but accessing it in an emergency means the government takes another large cut on top of that. In Q1 2020, during the COVID crash, Fidelity reported the average 401k balance dropped 19% in a single quarter. By Q2 2022, average balances were down roughly 20% year over year due to rising interest rates and inflation. Crisis after crisis, retirement accounts have proven they can be devastated at the worst possible moment. The retirement account that was supposed to be your foundation of security becomes a trap, punishing you most severely at the moment you can least afford it. The fourth asset that vanishes, life insurance, cash value, many. People buy a whole life or universal life insurance specifically because they are told the policy builds cash value over time. It sounds perfect. Protection for your family and a growing savings account you can tap in emergencies. Cut. The reality is far more disappointing than the sales pitch suggests. Surrender fees are typically highest in the first 5 to 10 years. In the first year, you may get nothing back if you cancel, since the surrender charges often equal or exceed the policy's early cash value. So, if a financial emergency strikes in the early years of your policy, when you most likely need help, you could surrender everything and receive almost nothing. The money you faithfully paid in premiums, largely gone. Universal life policies also carry a hidden danger. If you pay minimal premiums for too long, it can drain the cash account and may even cause your policy to lapse entirely. Lapsed policy means you lose everything, every premium you've ever paid, every year of protection. Tony, and there is one more trap almost nobody talks about. If you take policy loans against your cash value, which is often encouraged by agents, those loans accrue interest silently. If a loan is not repaid before you die, it is deducted from the death benefit, meaning your family receives far less than you intended. The life insurance policy that was supposed to be a safety net delivers far less than expected at exactly the moment a family is in crisis. The fifth asset that vanishes, stock market investments. Stocks have made many people wealthy over long periods of time. The historical record of the stock market is genuinely impressive across decades. But here's the truth that brokers and financial influencers rarely mention. The stock market's worst crashes happen precisely when the rest of the economy is also collapsing. When you lose your job, when medical bills pile up, when businesses close. That is exactly when you are forced to sell at the absolute worst time, between January 1st and October 11th, 2008. Owners of stocks in U.S. corporations suffered about $8 trillion in losses, as their holdings declined in value from $20 trillion to $12 trillion. It's $8 trillion evaporated in months, not years. During the dot-com bust, large-cap stocks fell over 40%, small-cap stocks fell over 35%, and international stocks fell nearly 47%. And markets can stay down for years, meaning someone who needed to sell in 2009 had no choice but to accept catastrophic losses. There is also the psychological trap that destroys even disciplined investors: panic selling. When you watch your life savings fall 40% in weeks, the emotional pressure to stop the bleeding is almost unbearable. And panic sellers lock in their losses permanently, missing the recovery that always eventually follows. The next crisis will be equally unexpected. And when it arrives, stock market wealth, which looks solid and real on your brokerage statement, can vanish with terrifying speed. What you can do right now, the goal of this story, is not to frighten you into financial paralysis. The goal is to make sure you never confuse the appearance of wealth with actual financial security. Every asset we covered, real estate, cryptocurrency, retirement accounts, life insurance, cash value, and stocks, has real value under the right conditions and with a long enough time horizon. But none of them are emergency lifelines. The foundation of real financial resilience is something far simpler and far less exciting. Liquid cash, savings, money immediately accessible in an FDIC-insured bank account is the only asset that is truly there when everything else disappears. The wealthiest and most financially secure people do not rely on a single type of asset. They diversify across liquid and illiquid assets. They maintain emergency reserves, and they never assume that paper wealth equals accessible wealth. Understanding the difference between what you own and what you can actually use is perhaps the most important financial lesson of all. And it is one that millions of people learn only after it is already too late. Now, we want to hear from you. Have you ever been in a situation where an asset you were counting on failed you at the worst possible moment? Was it real estate you could not sell? Retirement account that collapsed? A crypto investment that crashed overnight? Share your experience in the comments below, because your story might save someone else from the same pain. And if this opened your eyes to financial realities you were not aware of before, please subscribe right now. Every week, we bring you the financial truths that Wall Street and mainstream media would rather you never discover. Your financial future depends on the right information, and we are here to make sure you always have it. Subscribe, stay informed, and protect what you have worked so hard to build.